Hello there. This is James, and you're watching Tixee Live. And a very good afternoon to all of you, and all of you a very happy Friday. In today's program, I want to have a little chat, or actually do more of a review of the recent NFP or non-farm payroll announcement we had just over an hour and a half ago. And ask the question, is this going to destroy the hope the market has for a Fed pivot? But before I get into all of that, don't forget, these little videos are for educational purposes only, and in no way whatsoever should they be taken as financial advice. I always suggest you do your own research, do your own due diligence, and of course, know the risks at hand before entering any trade. With that out of the way, let's get started. So, yeah, today's NFP, the market was really hoping that eventually they might see it starting to slow down. And though there is a tiny little, little sign that it is beginning to cool down a bit, it is still majorly hot. And it's still a better than expected number, a lot better than expected number. The actual announcement, it actually came in at 263,000 versus the 200,000 expected. 263 versus the 200 expected. For those of you who were kind enough to join me for the watch along, as we discussed, we did say that this year Wall Street has got it wrong with their expectations on the NFP number throughout the whole year. Like I say, every expectation has been wrong. But something else which was also happened. This is where I want to sort of have a little chat about it. October's number, which initially was announced at 261,000, that was actually revised higher to 284,000. So it's still a very hot labor market. It's still no signs of it slowing down at the moment. But I like to point out, like I did in the watch along, though it is better than expected, and Wall Street's been getting it wrong time and time again this year, it is still slightly declining a bit. I mean, if it's 284 last month, it's 263 this month. That is a bit of a drop. Not a dramatic drop, though. It's not a big enough drop. But let's see, to be fair, that 263 number is probably, if we look at it, the lowest reading we've had this year. Okay, January 504,000, February 714, March 398, April 368, May 386, June 293, July 537. That was a shocker. August 292, and September 350, and October now revised to 284. So that is the lowest reading of the year. So it is slowing down slightly. And if we have a look at it, the main industry which is not slowing down a lot with job growth is the leisure industry. That added 88,000 new jobs. Healthcare also expanded by 45,000 new jobs. Government, 42,000 new jobs in this number. So those sectors are not slowing down. There is a slowdown in some sectors, though. Okay, the retail sector was down 30,000. Trade industry is actually down 62,000 since August. Transportation was down 15,000. So we are seeing a slowdown in some sectors. But like I say, the leisure industry is steaming ahead. This is why this number was pretty impressive. And this is what's caught the market. And we'll look at the market and the charts in a minute and see how the market's reacted, and how's the feeling going. But something else which came in as well at the same time, which is not good news for the Fed. It's not good news for the Fed. Not at all. This puts pressure on them again. And that is the fact that average earnings month on month was announced at 0.6% versus the 0.3% expected. So higher again. And US average earnings year on year was announced at 5.1% versus 4.6% expected. Now, this is going to put a lot of pressure on the Fed to do something more. Because they need to get on top of inflation. They need the labor market to start to slow average earnings and new jobs. Market participation rate is also fell slightly, but only by 0.1%. It's actually 61.1%. Last month it's 61.2. So there's still plenty of people in the market. They are jobs. And because the labor market is so strong, obviously employees are desperate to keep them, are paying them higher wages. So this is the issue they have, because when you have average earnings, it's still climbing, and you've got low unemployment because unemployment came in at 3.7. This keeps inflationary pressures elevated. It keeps inflation high. So the only way for the Fed to get down to their 2% target is if they try and cool down the labor market. And this is what they've been trying to do with their interest rate cycle, with their, they've been very aggressive. So the question is, I had this question asked me in the watch along, and that is, does this again destroy the hope of the pivot? Because don't forget, we've had plenty of bulls in the market over the last couple of trading sessions, down to the fact that yes, we got signs that inflation is beginning to cool. Not cool enough though for me. It's still taking its time, and that obviously we had number of Fed members or FMC members saying about not slowing down or decreasing the size of the increments on interest rate decisions. And in fact, Jay Powell even said that they might do a lower interest rate hike in December. So this is why the market's thinking of 50. When they're thinking about doing slower ones, they're thinking that's a sign. And this is why I think it's silly for the market to think this. Excuse me. They're thinking this is an indication that the Fed will do a pivot soon, i.e. reduce interest rates. And they are expecting them to reduce it next year. I'm not convinced they will. I think, like they've said in the past, they will keep interest rates high. And this is again what the market forgot, what Jay Powell said it several times. They will keep fighting inflation for a much longer period of time than expected. They're not thinking of getting down to 2% straight away. Don't forget CPI is 7.7 already year on year. So they're miles away from 2%. And I think they will keep interest rates high. I don't think they'll stop at 5 either. I think they'll carry on going a bit higher because they're clearly, the fact they've been the most aggressive of interest rates since 2008, and it's not really denting. It's dented slightly, but it's not stopping the labor market. And it's bringing down inflation slightly, but not that dramatically. They'll be fighting this for a long period of time. And like I say, the hope of the pivot, in my opinion, never should have been there. Never should have been there. But anyway, let's have a quick look at the markets and see how it's reacted. Let's start off with the euro. With the euro. Here we go. Let's have a look. So as you can see, look, on the initial announcement of this higher than anticipated labor number, the euro, which was trading above the 1.05 handle, came under pressure, and this is on a 30-minute tested the 200-day moving averages. Since recovered slightly, but it's not riding as high as it was at the beginning of the session. If you look at the daily again, we are trading just above that key area of interest, 1.03882, which is the 200-day moving average. It is capped, in my opinion, for the time being, at the 1.05240 level, initially potential area of interest, followed by 1.06017. The sterling, same story as well, was riding high, but after obviously the decision, the job report, it came under pressure again. It was trading at 122, currently trading just above 122 again now, managed to get a bit of buying just above that 200-day moving average. In general, though, like I say, on the day, it looks like might be closing with losses today, but it's got that key area holding it up at the moment, 121.092. Dollar yen, we've been talking about this today. Yes, it was testing below the 200-day moving average on the day, but again, it found its support on the back of the better NFP number, and it's currently trading now 135 again. It was under 135, challenging mid 134, but it's currently trading now 135.38. And of course, gold, same thing. It's been struggling all trading session to get past that $1,803 level, which I've been watching for a long period of time. It's definitely a key support. Came under pressure, but like everything else, it's off the lows. But still, that labour market, that job market, job report is damaged its shine a little bit. S&P 500, let's have a quick look at that, how that reacted as well. Again, broke down heavily on that. But again, it's now managed to get above the 200-day moving average again. So off the lows again. So yeah, like I say, it's taken the wind out of its sails slightly, but it's holding above that 200-day moving average for now, 4,021 points. So there we go. There we go. The labour market is still strong. They don't see, what to do with it. But what a week we've had. Let's face it, we've had a lot of bulls in the market this week. Sorry. Obviously, really fueled by obviously the FOMC. Jay Powell's speech on Wednesday, which really spurred the market. Again, I don't know why, because he never said anything new, which we don't know already or not anticipating already. And he has kept saying the same things he said before, but this time the market looked at it a bit differently. So yeah, we have had a bit of a bull market today. This week, sorry. And of course, we've had NFP today, which is taken a bit of the wind out of the sails of the bulls for now. I just want to see if they can maybe start giving up on this pivot hope. But that's been a really interesting week. But guess what? We've got another exciting week to come. Next week, we have EU retail sales, Iceman Services PMI. That'd be interesting, especially after manufacturing PMI was disappointing. RBA, Reserve Bank of Australia, interest rate decision. Australian GDP, EU GDP, Bank of Canada interest rate decision, and mentioning consumer sentiment. Some major events, not earth-shattering events, but obviously the ISM Services PMI, that would be interesting. And be interesting to see what the RBA does as well, because they have promised to be a bit more aggressive, or hinted at being more aggressive in the future. So that would be interesting to see what they do next with that. It's the equities in the US session, how they stand. Again, slightly off the lows. S&P down negative 0.98%. NASDAQ negative 1.47%. That's not 147. And S&P, Dow Jones 30 negative 0.84%. So there we go. That's the week. What a week it's been. What a week coming next week. I mean, like I say, we need to see how the market thinks about the pivot. I think in many ways, I think what it is, and I've seen a number of investment banks are saying this. They're expecting a reasonable end to this year. Okay, so they're expecting a small rally by the end of the year, but they're expecting the beginning of quarter one, 2023, for the market to start to crumble again. But again, let's see how long this hope with a pivot remains in place. I don't think it's going to happen. I really don't. But anyway, don't forget you can ask me questions anytime you wish, or simply say hello if you like. Okay. And don't forget, if you think of a question later, you can simply put it in the comment section on Facebook or YouTube. I will see them and I will reply to them next time I go live on air, which of course will be Monday, back on at 9:30 a.m. UTC, discuss the European session and see how the market's reacting off this NFP report. If there's no questions, not a problem. Don't forget, if you're watching me on Facebook and you enjoyed this little video, by all means, give us a follow. If you're watching me on YouTube and you enjoyed this little video, subscribe if you like. Hit the notification button so you know next time I'm going live. If you enjoyed this video, find it interesting, useful, and you put up with me, then give me one of these. It's nice to know that you like what I do. Anyway, till next time, don't forget, these little videos are for educational purposes only, and in no way whatsoever should they be taken as financial advice. I always suggest you do your own research, do your own due diligence, and of course, know the risks at hand before entering any trade. Till next time, every single one of you, trade safe.